Let's stay on the markets here with Noah Hamman, CEO of AdvisorShares. Noah, always good to see you. Give us some positive news. Give us a good trade to be making in this, not us, but viewers, a good trade to be making in this environment. The initial jobless claims data wasn't good. Has some new home sales data just hitting the tape. That's not good either. What should investors be gravitating to?
I think probably getting hedged. It's the same message from last time. I know it's probably not the news that people want to hear, but I would be hedging myself in this marketplace. There's still a lot of uncertainty. There's an outstanding number of people that are, not working right now. The number is just a pile on from the previous numbers. I think the total now is somewhere close to 25 million people out of jobs. And so the numbers aren't great. You got to look at something like a HDGE or a DWSH. They're two short equity ETFs that can actually add some performance to your portfolio. Probably not today, as it looks like the markets are heading up, which is terrific. But I think over the course of this year, they're going to add some value to your portfolio.
But Noah, you actually point out that it's really important for investors to be careful they're using the right ETF to hedge their portfolio. What's the criteria here in this environment for the right ETF?
It's just understanding what the ETF does, right? So we've seen the news this week with the USO ETF and people kind of understanding that, hey, this isn't following the price of oil, it's following the price of this futures contract that in and of itself went sort of crazy. And we run into the same thing, having alternative investment strategies in our lineup, like the two products I mentioned that are short equity strategies. There are some products out there that are called inverse funds. They're passively managed. They just provide the inverse of an index, but they only do it for a day. And so the product sponsors are great about articulating that, but investors, similar to probably what we saw with the USO ETF, don't maybe always understand what that means. And so if you are hedging over a market cycle because you think it's going to be bad for a while, you want to be careful of those products. And just as an example with some numbers, the inverse, single beta inverse, passively managed ETF with the ticker symbol SH, I believe is up, let me look at the numbers, 8.37, and this is year to date through April 21st, but the market's down 13%. Some investors, not all, think that fund should be up 13%, and it's not, and it's because of its daily investment objectives. So short funds like DWSH or hedge, for example, over the same time frame are upwards of, I think hedge is up 23.18%, and DWSH is up 35% just this year to date. So understanding the difference, if you're the type of investor to hedge, and you always want to be careful and know what you're investing in, but understanding those differences are critical.
Yeah, just a quick follow-up. March new home sales down 15.4% month over month. Just stunning data we continue to get from the U.S. economy. No, we're in the eye of the storm of earnings season. What are some of your takeaways so far?
Well, the target numbers were incredibly impressive this morning, right? In some ways, not surprising as we think about who's benefiting and what companies and sectors are benefiting in this environment. But I think, more pain for longer, unfortunately, between the unemployment numbers, not surprising to see lower housing start numbers. Maybe there's some value to be found in the energy space, even though we're mostly short some of those equity positions. But maybe there's some opportunities there as things start to turn around a little bit. And I think that's the important thing. I'm so optimistic that the economy is going to turn around. It doesn't actually mean that the stock market's going to follow along with it.
And Noah, I just want to bring to your attention and to our viewers' attention the latest economic report showing a record drop in business activity, according to IHS Markit. And this, of course, is consistent with figures we're seeing come out of Germany and Japan, Australia, indicating a worldwide recession. For those who don't want to play in equities right now, U.S. or otherwise, where should they put their money, or do they just sit on some cash at the moment?
I would go cash, or I think one of the things we talked about last time, which I think is still a good position, which is probably longer maturity treasuries. I don't think interest rates are going to be heading up anytime soon. And in fact, there still could be more downward pressure. You want to be in a safe type of investment. Treasuries are there. But given where I think interest rates might be going, you can actually see some total return or some capital appreciation with that allocation. And it's not, sell everything and forget about it, right? There's a portion of my portfolio that is for the very, very long term for my retirement, which is hopefully out in the future sometime. But that I'm not getting too aggressive on. I'm still dollar cost averaging. But if you have the ability to protect yourself or you're looking for places to put new money today, you want to be defensive, either get hedged or look at cash or look at longer term dated treasuries.
Yeah, no retiring yet, Noah. We still need your market insights.
Thank you, I appreciate it.
Right? How do you play? You're the ETF master here. how do you play rising bankruptcies in the U.S.? I'm worried about retail. I'm worried about a lot of industrial companies. Also worried a lot about U.S.-focused small businesses.
Right. It's a tough one. I think, shorting's the way to do it. Getting out of the way with cash is the way to do it. There's actually not a lot of investment options in terms of, say, inverse credit. Those are very difficult products to build because in the times where things are good, the decay with the interest payments can make those products very challenging. So I think your only places to go, are probably, in big blue chips, right? Hang out there. The target numbers, I would look at that. When I think things are going to start to turn, it'll bring the blue chips back up. And like we saw early in this cycle where the smaller caps and the micro caps were the first to indicate there's problems ahead, they'll be the last then to turn. So I would just stay in high quality equities. If I have to be in the market, I would go to cash, treasuries, or if you're comfortable, shorting the market can provide some positive returns, maybe in a small allocation in your portfolio.
Noah, we've talked before about the energy sector, not doing what it's doing right now. I mean, an unprecedented cratering for the oil markets. But I know you don't have a lot of exposure in that space, but what do you have right now, and are you holding it given this unprecedented drop in oil prices?
Sure. So I think Chevron is the name that I just saw come up in the double line equity. It's a value ETF strategy. They have a small allocation to energy. They're underweighted compared to their benchmark of the Russell 1000 value, but they are picking and choosing some companies in there that they think can be the beneficiary of a change in those oil prices. So, and I think that's in general where we are. And I'm biased when I say this because all of our strategies are actively managed, but this really should be the environment for active managers to shine. You can find those opportunities even in a tough sector like energy. You just got to be stock selective and have some very good insight in those companies.
No, one thing that has caught my attention, I got a note from one of my friends this morning. The NASDAQ 100 to S&P 500 ratio is at its highest level since 2000, the dot-com bubble. Are we seeing some kind of bubble in tech stocks, and does that surprise you?
Well, you're definitely seeing them being a bit more defensive in this market. It probably doesn't surprise me, no different than seeing online sales for Target go up dramatically or seeing some of the numbers you saw from Netflix the other day. It feels like in this, current, not fair to say post-pandemic world yet, I think the tech companies are going to do well. Look at what's happened with Zoom stock and look at the aggressive moves that Microsoft with Teams and even Google is making with their own meeting software, seeing that this isn't going to probably slow down anytime soon. So I don't, they haven't detract or declined as much as the rest of the equity space. But I don't know that I would call the tech space a bubble just yet. I mean, overall market decline, sure, but I think they're going to weather it probably better than others. Certainly the retailing and consumer cyclical space, things like that are, I think, absolutely going to underperform the rest of the year.
All right, let's leave it there. Noah Hamman, CEO of AdvisorShares. I will reiterate, no retiring.
Thank you. I appreciate it.
Hey, investors. Zach Guzman here. Are you interested in learning more about the markets and getting the latest financial news? Well, then click right here to subscribe to our Yahoo Finance YouTube channel. Get the latest up-to-the-minute market analysis, big interviews in the world of finance, and information on how to manage your money every day wherever you are.